afternoon, everyone. Welcome to the 3Q earnings call of V-Guard Industries. We have the management being represented today by Mr. Mithun Chittilapilli, Managing Director, Mr. Ramchandran Venkatraman, CEO, and Mr. Sudarshan Kasturi, CFO. At this point, I will hand over the floor to Mr. Mithun for his initial remarks, post which we can open the floor for Q&A. Over to you, sir.
Thank you, Manoj. Very warm welcome to everyone present on today's call. Thank you for joining us today to discuss the operating and financial performance of our company for the third quarter of the financial year 23-24. I trust all of you have had a chance to refer to our investor presentation, which was shared yesterday. Consumer demand remained soft for most of the quarter, presenting a challenging backdrop, though we saw some revival towards the end of the quarter. In this context, we have delivered a resilient performance as we have reported a consolidated net revenue of 1,165 crores in Q3, higher by 18.6% on a YOY basis. This is excluding the revenues from Sunflame. The like-to-like revenue growth is 10.9% YOY. In Q3, we saw balanced growth in a geographical basis as the South market grew by 10.6% YOY, while the non-South market grew 11.2% YOY. We continue to progress well on our strategy to scale contribution from non-South markets, ensuring better diversification for V-Guard across all regions of the country. The electronic segment, comprising of stabilizers, inverters, and batteries, delivered good traction with revenue growth of 16.7% YOY. In the electrical segment, which remains our largest revenue contributor, comprising of wires, pumps, switchgears, and modular switches, we registered a growth of 8.3% YOY in Q3. In the consumer durable segment, where we market fans, water heaters, kitchen appliances, and air coolers, the revenue growth was 10.9% YOY. In the case of Sunflame, we had grown revenues by 2% during the quarter, successfully arresting the decline witnessed in the first half of the year. This gives us confidence that the actions we have undertaken are yielding results, and we are hopeful of accelerating the business in the coming quarters. We have reported an improvement in gross margin to 33.9% this quarter from 29.7% in Q3 last year, an increase of 420 basis points YOY. Gross margins have continuously improved over the last few quarters, and we have substantially closed the gap that existed at the beginning of the year. EBITDA excluding other income was 102 crore in Q3, an increase of 52% YOY basis. The EBITDA margin stands at 8.7%, 190 basis points higher than compared with 6.8% reported in Q3 of last year. Some one-offs have contributed cost increases under the other expenditures. There was a write-back of bad debt provision of around 11 crores in Q3 of last financial year, which makes it a low base. We have also made a provision of 4.5 crores for end-of-life product recycling as required by recent legislation. We have also accrued 4.5 crore towards the strategic projects in the electronics department. Profit after tax in Q3 was 58 crore compared with PAT of 39 crore last year, an increase of 48% on a YOY basis. With stable working capital, cash flow remains strong. We intend to repay the term loan taken for Sunflame acquisition over the next 4 to 6 quarters. In V-Guard Consumer Products Limited, our wholly owned subsidiary, we are progressing well as the manufacturing units are coming up as scheduled. The electronics plant at Pantnagar is performing well. The battery plant at Hyderabad and the kitchen plant at Vapi will commence production in Q4 of this financial year. With the upcoming summer season and indications of demand revival, we remain hopeful of a stronger top-line growth in the coming quarter. With that, I conclude my opening remarks, and I would like to thank Manoj and the team at Equirus Securities for hosting this call, and I would like to request the moderator to open the floor for Q&A. Thank you.
The first question is from the line of Rahul Agarwal from Incred Equities. Please go ahead.
Hi, am I audible?
Yes, sir, you're audible, sir. Please go ahead.
Okay. Good evening, and thank you so much for the opportunity. My questions are a bit longer term, Mithun, so just wanted to understand a few things. Firstly, on the V-Guard standalone business, between the three revenue segments, I think more or less we have different product classifications. My sense is ECDs will see the maximum growth, followed by electricals and followed by electronics going into next 3 to 5 years. The ranges could be 12 to 15 for ECD, 10 to 12 for electricals, and 7 to 8 for electronics. On top line growth is what my understanding is on a CAGR basis. Which products within this could surprise? Because, what I understand is 11 to 12% is what we target on a CAGR basis for the overall company. It would help me understand which could surprise and what is the way forward. That will be really helpful. Thanks. That's my first question.
So I think we have different categories of different maturity. If you look at, wires, stabilizers, and electrical water heaters, these were traditionally large categories for V-Guard, and where we are having a substantial market share, and our opportunity to grow organically in these segments are limited. So I wouldn't say that there is any surprise, but we can say that we internally look at, categories as matured and emerging, and but categories like modular switches, switchgear, kitchen, including Sunflame, these are all category fans for us. Although fan is an old category generally, but for V-Guard it's relatively a new category and growing fast. So these are some of the categories that will tend to grow faster. I wouldn't say any one category will suddenly surprise us or something like that, but the opportunities to grow in some of these categories mentioned later are more than the earlier categories, which are older categories, and V-Guard has covered a significant part of the market already.
So these categories fall into electricals and ECDs largely, right?
Yes. So electronics, there is a category like inverter and battery which is growing fast, but stabilizers is a very old category for us. It's the largest category. We are the largest player. So we can't possibly grow much faster than the industry is growing. So it will probably attract the industry growth. Yeah. So you're right. ECDs will grow the fastest, followed by electricals and then electronics. Yes.
And on the margins, would 9.5-10% range, over the next 2 to 3 years, is that a fair assumption? And what could surprise there? Because I think a lot of ground has been recovered now.
A lot of ground has been recovered, but we still not have, we still have margin, we would like to improve margins in the ECD segment. ECD margins, as you can see, are the lowest. So we still have a lot of work to do in that area. We have initiated certain actions in terms of, margin improvement projects. So, for example, the kitchen factory in Vapi, to a large degree, will address a lot of the margin issues happening in the kitchen appliances space, which is housed in ECD. We have initiated a lot of new launches and product revamp, followed by, interventions in manufacturing for fans, which is also showing good results. I think if we fix these two, largely the margin issues in ECD should also start to look much more healthy than what it is today. Even though we are, investing more in ECD because it's a lot of new categories we are incubating.
So 9.5 to 10 is the range long-term sustainable? Is that fair?
Yes, even this year, I think we will be hitting close to, we will be closing somewhere between 9 to 9.5% in, EBITDA margins in the current year. So yeah, that is sustainable. We had a very adverse, raw material price inflation environment, and as you can see in the last 3 quarters, sequentially, gross margins have been moving up, and they will continue to go up even through next year.
Got it. Second question was on Sunflame. It's been almost a year, I think, we are reaching in terms of acquisition. I wanted to get your sense on, three things. Channel, you've discussed that you want to move, more more online, modern trade e-com. But on geography and product, North and West is 80% of sales. One question here was, are we going offline for white spaces here? On the channel, obviously, the intention is to increase modern trade e-com. That's where the industry is. But are the margins similar offline versus GT and online? And thirdly, on the product, I think cooktops, chimneys, and hobs and hoods, about 50-60% bulk of the top line. What could be the top three products, to be sold going into next 2 years? What's your plan for the same?
Okay, so I'll ask Ram to answer this. I think it's a very longish question, so as much as we could have understood, we will answer and then we'll come back to you. Ram?
Yeah. No, as far as Sunflame is concerned, I think you talked about, yes, I think, about 30%, 25 to 30% of the kitchen business is coming from e-commerce. Yeah. And the organized retail is also a significant player in this space, right? And some of the categories are also driven by, own channel, particularly built-in, cooktops and stuff like that, for hoods and all. So I think from a channel perspective, we will have to develop these areas. I think we are in the course of, what I would say, supporting the transition. So I think we have strong teams in V-Guard to address, emerging channels, and these teams are working together. And I think we should be helping. They should be helping Sunflame to penetrate in these two channels. Yeah? I think the preparatory work is complete as far as e-commerce is concerned, which was basically, making sure that, the team could transition in, get hold of pricing, get supply chain in place and, all of those things. And I think from the upcoming quarter, the current quarter that we are in, I think we should start to see gradual traction as far as kitchen is concerned. It takes 2 to 3 months. Our GTM for kitchen is very different from Sunflame. Sunflame has what I would say an intermediary through whom they go to market. Whereas we are directly present on the platform as a company. So I think and that requires different preparation. So that's why it's taken some time. I think, but the preparatory work is out of the way. And it takes about 2 to 3 months, maybe even 4 months, before products take online traction. Yeah. That's as far as e-commerce is concerned. I think the MT-RSS conversations are ongoing, and the teams are in place, and we should see quick traction in that area also, modern trade and RSS. Geographically, I think we have set up a new team for South for Sunflame. Sunflame has been absent in the South, or rather had a thin presence in the South, primarily some strong presence in Andhra, but very weak presence in other parts of the market. I think the team is on the ground from about from the month of August, September, and we should see traction happening from there also. Yeah. As far as so that is as far as the channel and the geography part that you were talking about. In terms of the category part, I think gas and what I would say hoods, and built-in. Yeah, I think these are going to be the three primary revenue drivers as we go forward. Built-in, of course, will require investments in terms of shop and probably exclusive stores where relevant, right? So I think that's something that you can expect to see going forward over the next 12 to 18 months. Yeah. Now coming, so I think that's covering the channel and the product dimension. What were the other questions? Sorry, the first part of your questions I have.
So basically the only part left is a bit more specific on the product side, like top 3 products sold into next 2 to 3 years. Will the mix be largely same or it will change?
No, it will be largely same. I think the contribution of hoods will go up. Okay, but otherwise, the contribution in the near term will be the same. But maybe probably over a 5-year horizon, the built-in will also become significant. Yeah. But maybe less significant in a 3-year horizon, right? So.
Got it. I have more questions. I'll come back in the queue. All the best. Thank you.
Thank you. The next question is from the line of Aditya Bhartiya from Investec. Please go ahead.
Hi, good afternoon, sir. My first question is on the provisioning bit that you spoke about. Could you just repeat that about what are the provisions that have been created in this quarter, and what was the strategic project that you spoke about?
Okay, the provisioning.
So there are two one-offs which Mithun mentioned. The first one is related to a new recent legislation. It's called the Extended Producer Responsibility. It says that these products have to be collected back at the end of their life and recycled. Okay. So there is we have provided some amount for that. That was one of the one-off items. The second one is relating to some strategic intervention in the inverters business. So that's a project we accrued some 4.5 crores this quarter. So that's the two one-off things.
Okay, and this extended producer responsibility bit that you did, that was in respect of sales that have been made in the past. Have these provisions been created on a retrospective basis?
Yeah, it pertains to sales made in the past. The collection responsibility happens now.
Understood. And that amount also is roughly 4 odd crores, right?
Yeah. So both are like 4.5 each.
Understood. And what's the strategic intervention in stabilizers that you're speaking about?
No,
inverters.
It's basically a sales. We had some margin issues in inverters and battery businesses, and we also wanted a accelerated sales program done. In fact, this project was discussed before COVID, but due to COVID, we had we couldn't start the project, so we are doing it post COVID once the market has stabilized. So it's basically working on margin improvements and sales acceleration in the area of inverters and batteries. Now we have put up two world-class plants for manufacturing inverters and one for manufacturing batteries. We wanted to make sure that those capacities are used up quickly and profitably.
Understood. But this is a cost that you will continue to incur in the subsequent quarters as well, correct?
Ram, you want to comment? I think they may not be phased equally. So phasing wise, some quarters will be more than, every quarter we may not incur this. So Ram, you want to comment on the...
Yeah, Mithun, you are correct. There is a phasing issue also here. So it's likely that, 1 or 2 quarters, the initial phasing, in the design phase, the team size is large. So there is, the loading will be high. And then, it will taper, at least as far as the consulting is concerned. The EPR responsibility is, past provisioning, right? And the ongoing provisioning is thin and limited, right? So.
Sure. Understood. My second question is on the demand scenario that you spoke about, wherein you said that you have started seeing some green shoots towards the end of the quarter. If you could just elaborate a bit about on that. What are the changes that you have started to see? Which are the verticals wherein you are seeing stronger growth? And specifically on something like fans, which is a market which I think has gone through a prolonged slowdown. What's the demand scenario looking like?
So I think to put it in context, last year, was the year when we had to, cease selling, non-star rated fans. And what we saw in the fan industry was there was significant amount of dumping by almost all players, because they had to significant discounting and dumping of, the old, type of fans. But this fact was known to everyone at least for 12 months. So for V-Guard at least, we stopped selling of these fans in November itself. So from December onwards, our sales is primarily for the star-rated fans. So in that sense, we did not have this huge, overhang of discounted and obsolete products in the market bearing V-Guard's brand name for a long period of time. I think we had but I think that is probably the reason that for us, at least in Q3, fans had grown well, because our last year Q3 was not a bumper quarter. It was a normal quarter for us. Because of that, our sales have recovered faster, and we are having fresher inventories in the market. So I think for us at least in Q3, fans have done well because our base last year was not that high. Even in this quarter, I think it will do well because we have some new launches and there is some good traction we are getting in the market. But overall, we saw improvement in December. I think barring water heaters where the weather was not that cold, at least till the third week of December, there was a slowness in offtake. Except for electric water heaters, the rest of the products we saw improved sentiment in the month of December. And Jan also has been decent. So yeah.
Understood. Thanks a lot, sir.
Thank you. The next question is from the line of Bhavin Vitlani from SBI Mutual Funds. Please go ahead.
Thank you. Mithun, looks like good performance is now starting and hopefully it continues. So I have a couple of questions. If you could just maybe give us on the fans as a category, because what we have seen from the other peers after they reach a 300-400 crore kind of a range, then they kind of stagnate. So for V-Guard, we understand now it's closer to $100 million plus. So how kind of you can go to 1,000+ crore category and then grow also? That's the question one. The second part is if you could just help us with what are the management changes you would have done at the Sunflame and the other changes that you are doing. Maybe if you could talk about it qualitatively, that we could see some acceleration in the growth after that. And the last bit of the question is on the margins. So within the ECD as a category, if you could just give us a flavor in terms of which is the category that is under-indexed in terms of the margins, and what are you working to get the margins to the double-digit category? These are my questions.
Okay, so I'll answer the margins part first, and then I will, give the rest to Ram. See, in ECD, we have fans, water heaters, and kitchen appliances. These are the three large, contributors to the ECD business. We also have air coolers, but that's, smaller in size. In that, both fans and kitchen, we are under-indexed in terms of margins. In case of fans, it's also an issue of scale where, fan is a very large market. So even at, $100 million, we're getting better, but the scale is not, it cannot be matched to some of the larger players in the industry. But in all these places, what we have done is two things. One is we have gone for a backward integration. That means if you look at us, 6 years back, from almost outsourcing 100% of fans and kitchen appliances. At least in the case of fans, now almost 50-60% of the ceiling fans are made by us, which gives us a lot of advantage. One, in terms of fit, finish, quality. Two, in terms of the ability to differentiate. And three, also there is a cost advantage. So that is one axis, and we will be pursuing the same thing for TPW fans as well as kitchen appliances. The kitchen factory will come in this quarter, and TPW factory is supposed to come up in the next financial year. So with these things, we believe that the margins can be better. In the case of even in the case of electric water heaters, we are not fully happy with the margin because we are slightly under-indexed in the premium part of the electric water heater market. So our sale is primarily coming from the mid-segment and lower end where the margins are not that great. So we are undertaking actions to, have a better, lineup of products. And just like we've done in fans where we've consistently launched premium models in the last 36 months, we will continue to do that. We will start that activity in water heaters. So all this should significantly improve the health of the consumer durable segment. One more thing we have to keep in mind is we are also investing in A&P. We are investing in, disproportionate manpower. We are investing in, a lot of other promotional activities because ECD houses a lot of the new categories. So that's also one of the reasons why, as a combined basket, ECD looks, slightly lower margin. But we have gotten a lot better this quarter, and I think they will start to see, continuous improvement. So this is as far as the margin, profile and all that regarding ECD. Ram, you want to take the other two?
I have a just follow-up, on your response. Are the gross margins in the ECD comparable? So it's more to do with, as you said, scale and a greater E&P. So as the revenue or the size comes up, that's the whole answer to the margins or double.
Yes, to a large degree, yes. But like I said, even in fans today, 60% of the fans are still outsourced. So purely on a gross margin basis also, we may not be fully comparable, because when you are in the outsourcing model, your gross margins are going to be low. Your ability to differentiate is very low because, you're getting supplied from. But yeah, to a large degree, yes. So our gross margins are healthy. I think if you look at kitchen appliances business, our gross margins are probably comparable. In the case of fans, we still have maybe a few percentage points to go as far as gross margin is concerned. But I think we are getting better. I think our presence in the premium segment of ceiling fans is improving much better than what it was 5 years back, and that is definitely. So it's also a mixed issue, right? It's not only that it's not only good enough to sell 600-800 crores of fans. We need to also sell the right type of fans to ensure that the business remains profitable, and that's where we are doing work and will continue to do work.
Sure.
Yeah, just one more point to add to that, right? If you take something like fan, I think the throughput also matters, right? At different output scale from the factory, conversion costs can significantly come down, making it's not only the cost below gross margin, sometimes even the manufacturing conversion cost, right? It's not only the frontline sales overhead, but also manufacturing conversion cost can also be a load. But fundamentally, yes, our businesses are competitive, yeah, and mostly issue is of scale.
Sure. Ram, you want to take the other two?
The second, I'll go with the second one. The first question I forgot, and maybe you can remind me. So coming to Sunflame, what changes we are making? Fundamentally, okay, in Sunflame, we have onboarded, 4 key talent. One, we brought in a CEO for the business. We brought in a CFO for the business, and we have brought in a person to look after the supply side of the business, right? And one for HR. So these are the 4, people, we have brought into Sunflame to manage and support the Sunflame business. That was the first part. The second part, the emerging, the business of e-commerce, the business of, modern retail and regional specialty stores, and the business of what I would say as, the CPC and CSD canteens. I think these, we are, what I would say, trying to support through also the V-Guard operating teams, because, surely we have deeper and longer relationship, and we have a unique, we have some unique advantages in terms of our business systems, particularly in e-commerce, or our relationship in, the organized retail space, which should benefit, Sunflame. So I think there, these parts are being managed, more recently from the V-Guard teams, right? Particularly the last, I would say 3 to 4 months, right? Second thing, what we have done is, we have moved, one of our customer service people, to support and redesign the service operations of Sunflame, so that we are able to achieve good turnaround time and first time fix, get the first time right, when it comes to complaints, right? I think that should lead to positive word of mouth, and should support the brand with the trade and consumers. These are areas that we have moved on. We have also tried to move fast and quick in terms of trying to, get some efficiencies going. And we have been able to observe significant opportunities for, efficiency in the area of transportation management, in the area of packaging. I think these are early quick wins. We are now working on the sourcing side, and we will see what comes up. We have also initiated a project which is working on the new operating model, which will be an integrated operating model where we will clarify sharply, what operations will be, jointly handled, mostly the back-end ones, and which operations will run uniquely, which is the go-to-market part of it, right? So that we get agility and we get quality and efficiency also. So I think that's we have a project going, which is fundamentally working on the operating model. It will also be working on the growth strategy for Sunflame. Yeah. So I think this we expect to have an output in place, by maybe June or July of this year, and that second half of this year we should be able to initiate action and start the rollout. Yeah. Also, we have commenced the integration operation, and we have put SAP in place in Sunflame, so that we have stronger controls over the transactional side, and we have we have the ability to have faster reporting of MIS, right? So now we are able to get the Sunflame results, second day or third day, so that we can make quick, better, and faster decisions. So these are some of the things that we have put in place. The first question, if you may just repeat, I think I can.
Sure. So that was on the fans as a category. I mean, if you look back last 20-25 years, so I think most of the entrants have kind of struggled with the smaller ones.
Yeah. So yes. Now I remember your question. That was on fans. So I think fundamentally, your question was, how will we be able to get, will we be able to get beyond this and not get stagnated like others, right? I think we are receiving good traction. And we do believe that we will be able to build out our business beyond 1,000 crore revenue in the next couple of years. That's fundamentally going to happen on the back of improved competitiveness and improved offerings, particularly in the premium segment, right? So I think these are the major drivers. I think there are some favorable factors out there in the market. So there are some changes that are happening in the market. Yeah, I think the BLDC itself is a significant change, and in this situation, the segmentation and the established offerings, right, are getting disturbed, and the new platforms are getting established in the market, right, and that presents a very good opportunity, for someone to be able to enter and establish new offerings in the market, because everybody is on an even footing then. Yeah. So I think that should help, and that should favor, and support someone like us and make it easier for us to establish, right? And fundamentally, the other thing that we are doing is, we are working to improve our visibility and presence in the retail, so that we can improve the ability for our fan to get into the consideration set of the shoppers, right? So I think we are bringing a lot of focus, right, in improving the displays of our offerings, because we have some great offerings, and they would merit significantly higher throughput, but many times constrained either because of reach or because of visibility. So I think there is a lot of focus around making sure that our offerings are visible to shoppers, and so that we are able to get better traction. So I think these are the primary drivers, which will support the growth of our fan business.
Great. I mean, that answers my question. Thank you so much.
Thanks.
Thank you. The next question is from the line of Shubham Agarwal from Axis Capital. Please go ahead.
Hi, thank you for the opportunity. Just a few questions. First one is on the electronic segment. Can you give what's the current breakup of stabilizers, inverters, and battery? That's one. And we've seen healthy double-digit growth in this segment this quarter, last quarter as well. Since stabilizers is a reasonably big part of this portfolio, what's leading to this growth, and what do you see going forward?
So we don't give out product-specific numbers. So, sorry, what is the second part of the question?
The growth has been good in this segment. How do you see it shaping up going forward? Because since we understand that stabilizer is a large part of this.
Yeah. See, what happens with the stabilizer business is largely dependent on almost 50% of the revenue comes from the air conditioner stabilizer segment within the stabilizer, and most of it is in summer. And same thing with the inverters. It's also a seasonal business, where a high summer is required for a good sale. What has happened is, from 2021, FY21, FY22, and FY23, we had disruptions either due to COVID or due to poor summer and stuff like that. So some of this is also that, the growth reverting back to its long-term, growth. And last year, for example, this financial year, we had very good summer in south and east, and we had very intermittent rains in north and west. So hopefully, I think it's primarily weather dependent. In the case of inverters, I think probably next year we will start to see some improvement in sales, because like we said, we are doing an intervention for sales acceleration. So some of that we are expecting to bear fruits next year.
Okay. Fair enough, sir. So this intervention which you've done, I believe this is 4 crores this quarter, and this will continue for how many quarters? Even 2 years, 3 years, or whatever? Will you give some sense?
So like I said, the project is running for between 12 to 14 months, but the charge on P&L may not be equal in every quarter. I think it will be this quarter we have booked 4.5 crores, but we are not expecting every quarter to be that. Maybe, next quarter it will be 60-70% of that, and then following quarter maybe, 10-20% lower than that. So it won't be like, it won't be an equal charge across all quarters.
Okay. Now, secondly, just would you be able to give some understanding, like where do we see all these categories going? I mean, category-wise, what you already highlighted earlier, that some products are mature, some products are not mature. But at the category level, would you be able to guide on the growth that you see over the next 2-3 years?
So I think on a blended basis, we should be looking at 12.5 to 15% growth. I think if you look at the current year, barring wires where there is some slowdown in the B2C segment, and we are largely present in the B2C space and wires, whereas the B2B part of cables and underground cables seem to be growing very well. The B2C part is slightly impacted due to various issues, inflation and poor rural demand and fluctuations in copper prices and so on and so forth. So even in the current year, we are looking at that kind of a growth, and we typically try to grow, our top line by 15% every year, and that's something we'll try to do. We don't give out, revenue guidance for by category. It may be difficult also to do because various things happen. 40-50% of our products are, heavily dependent on summer, and it's very tough for us to give out a long-term guidance on how it will grow, each year. So we don't typically do that.
Yes. Now, I just have one last question. This is on Sunflame. We saw good margin expansion QOQ in Sunflame. Would you expect this to sustain, improve? How do we, since you've also talked about a lot of efficiency and the things you're doing in Sunflame, the growth will pick up, we understand. And where do we see the margins?
Yeah, I think like Ram mentioned, I think we've had some margin improvement, quick wins like, transportation, packaging and all that. And there are more interventions being planned. I think as far as gross margin is concerned, we are very happy with where Sunflame is, and I think our focus will be more on accelerating the sale. I think if you look at the Sunflame margins today, they are at par or better than many of the industry players because of its superior product mix and price realization in the market. So our focus will be on improving the sales acceleration going forward.
Right. So good to understand that the margins at 10.8% broadly will inch towards that 14.5%, which was where Sunflame was earlier or in Q4 last year.
Yes, I think with the right kind of volume, we should hit that. And I think, but we will also, we will also try to invest more back in the brand. So I don't want to give out any margin guidance. So I'm just saying that we're happy with the gross margin improvement. A lot of the net, EBIT margins will also depend on how much we, plow back into A&P and on all that. And we will be significantly investing back in the brand because we would like to scale it up much larger than what it is today. So our focus may not be, to increase EBIT from this level, but more to increase sales.
Okay. Thank you. So broadly, I understand that the margins will be better than what they were this quarter, though they might not inch up too much. That's what my understanding is.
Yes, correct.
Yeah. Okay. Thank you.
Thank you. Our next question is from the line of Mukesh Patil, who's an investor. Please go ahead.
Hello, sir. Just one question regarding wire business. So what is the percentage of wire business in our business and how it is growing?
Yeah, regarding wire, I think we have mentioned that, wire is our largest category. But for V-Guard, almost 95% of our sales come from retail trade for house wiring cables. We are not present in industrial cables and LT cable and underground cable. In that sense, the wire business has been under pressure this year. I think our growth has been muted, not only us, across the industry. Primarily, we see that there has been huge inflation, across building product segments. And if you not only look at us, if you look at, sanitary tiles and those kind of companies also are, reporting, muted numbers. We also think that it can be a timing issue. So a lot of people are speculating that as there is a lot of push for housing coming in, 12 months down the line, the demand for electrification for those houses should pick up and then improve the sales of wires.
And what is the capacity utilization we are in for this business?
1 second. About 68 to 70% is the capacity utilization for the wire factory.
And what is the percentage of revenue wire business is?
Sorry, can you repeat the question?
So our wire business is what percentage of our total revenue?
It's about 27%, 28% of total revenue.
Okay. And what kind of capex we are looking for next 2 years?
No, wire, we just finished large capex in the last 18 months. We had expanded capacity, so I think we are having spare capacity, and I think even with a small investment, we can further expand the capacity. So today, I don't think we'll have any huge capex for the next 36 months for wire.
So overall business, I'm talking, not wire business.
Overall business, capex will be roughly 80 crores. I think this year also it will be about 80-90 crores. Next year also will be about 80-90 crores.
Okay. Thank you. That's it from my side, sir. Thank you.
Thank you.